Welcome to the Deep Dive. Today we're digging into the second quarter 2025 earnings from Abercrombie Fitch A&F. We're looking at this specifically for you, the experienced investor. We've sifted through the call, the reports, the notes to really pull out what matters for your strategy. This wasn't just a standard earnings call. It's a complex picture. Strong results, yes, but some pretty major headwinds too. So we'll walk you through the key numbers, the strategies, and then crucially, what it all might mean for the rest of the year. Okay, let's kick things off with those headline figures. A&F hit record Q2 net sales, $1.21 billion. That's up a solid 7% year over year. Comp sales grew 3%. Bottom line, GAAP EPS was $2.91. So remember, that included a benefit from some interchange fee litigation. More importantly, maybe adjusted EPS, stripping out those one-offs, came in at $2.32. That beat estimates by a few cents. Operating margin was, 17.1% GAAP and 13.9% adjusted.
Right. And those beats, they look good on the surface. Top line, bottom line, better than expected. But what's interesting is how the market reacted initially. Despite that strong Q2, there was this cautious feeling almost immediately in trading. It suggests investors weren't just looking at the Q2 wins. They were really weighing those wins against the challenges mentioned in the outlook. It's a mixed bag.
Exactly. Let's unpack that a bit more, because diving in, the difference between the brands was pretty stark. Really interesting stuff here. Let's start with Hollister, the teen brand. I mean, what a quarter they had, right? Net sales and comp sales surged 19%. 19%. That's record first half sales for them. Seems like they really connected with teens. Activations like Law of Pollusa, that collegiate collection, and all seemed to work.
Yeah, management literally said everything is working for Hollister. You don't hear that every day. And they put it down to being, quote, incredibly dialed into the teen consumer, basically knowing exactly what they want. Growth was balanced too, men's and women's. So it wasn't just one thing. This momentum, it's a huge driver for the whole company right now, a real bright spot.
Definitely a bright spot. But then you flip the coin and you look at the Abercrombie brand. A different story this quarter. Net sales there were down 5% and comp sales dropped 11%. Now, context is key here. They were up against a massive 26% jump in Q2 last year. So a very tough comparison. And the main reason they cited was lower AUR, average unit retail. They sold stuff cheaper, basically, to clear out old inventory.
Right. And it's crucial to remember, like you said, the context. Even with that 11% drop, this first half was still Abercrombie's second best spring ever. So perspective matters. Management sounded confident, about returning to growth by year end. They pointed to clean inventory now, good traffic, those denim events doing well, plus positive reads on new concepts like Boho and Western, store investments, and that NFL partnership.
We'll definitely get back to that NFL deal. Regionally, the Americas kept up its streak. 12 quarters of growth now, up 8%. APAC did well too, up 12%. But EMEA, Europe, Middle East, Africa sales were down 1%. Mostly weakness in Germany and some other European spots. The UK was still strong though.
Yeah, and they specifically mentioned trying to take what's working in the UK, that focused marketing, the store investments, and basically adapt it for the rest of Europe. Inventory-wise, they said they ended Q2 in good shape, cost up 10%, units up 7%. Tariffs added about a point to that cost increase, they noted. But the key thing is this lean position lets both brands chase demand in the back half. That means they can react quickly if something takes off. That's a good place to be operationally.
Okay, so looking ahead now, despite the Abercrombie dip and EMEA softness, they actually raised the full-year outlook for 2025. They're now guiding for net sales growth of 5% to 7%. That's up from 3% to 6% before.
Yeah.
Operating margin projected between 13.0% and 13.5%. And EPS guidance is now $10 to $10.50. Plus, they plan about $225 million in CapEx and roughly $400 million in share buybacks this year.
So that raised guidance, it definitely signals confidence from management, right? But, and this is a big but, it's despite some pretty significant headwinds they also flagged. The biggest one, tariffs. The estimated net cost for the full fiscal year has jumped to about $90 million. To put that in perspective, that's expected to hit the full year operating margin by around 170 basis points, 1.7 percentage points. That's a hefty impact.
90 million. Wow. That is substantial. How does that break down over the year, and what exactly are they planning to do about it? I mean, That's a big number to just absorb.
Yeah, it's heavily backloaded. They said about $5 million hit in Q2, then an estimated $25 million in Q3. And the big chunk, the remaining $60 million, is expected in Q4. These are mostly tariffs related to Vietnam, Cambodia, India, and China. Their mitigation plan, they called it a proven playbook. Shifting production globally, negotiating harder with suppliers, managing operating expenses tightly. Crucially, though, they said they do not plan broad price increases this year. They want to protect that customer value. which means they think they can offset a lot of it operationally. That's ambitious, maybe?
Ambitious is one word for it. Okay, so let's focus on Q3 then. Guidance is for sales up 5% to 7%, similar to the full year raise. Operating margin between 11% and 12%. But the Q3 EPS forecast, $2.05 to $2.25, actually came in below what the street was expecting.
Right.
So good sales, okay margin, but lower than expected EPS. What gives there?
That's the key question investors were asking, I think. Why the disconnect? It really comes down to two things hitting Q3 profitability specifically. First, that tariff impact we just talked about. The $25 million estimated hit falls right in Q3. That's a direct pressure on the bottom line. Second, and this is strategic, they're ramping up marketing spend significantly in Q3. They plan to boost it by over 100 basis points year over year. So more than 1% of sales going into marketing. That's to support things like the new NFL partnership and their big fall campaigns. So it's an offensive move, investing in the brand, even with cost pressures. But yeah, it definitely dings the Q3 EPS forecast.
Right, investing for the longer term, potentially. Okay, beyond the financials, what about those strategic moves? They mentioned store investments. Around 100 new experiences in fiscal 25. That breaks down to 60 new stores and 40 remodels or right sizes. Net increase of about 40 stores overall. And Abercrombie, interestingly, is getting about 37 of those 60 new openings.
Yeah, the thinking there is pretty clear. Even though they're very digitally focused, stores still matter a lot. They matter for finding new customers, for brand experience, just having that physical presence. It's classic omnichannel. Digital gives you scale and personalization. Stores give you the tangible experience. They work together. Giving Abercrombie most of the new stores suggests they see a lot of runway for that brand physically, maybe in new markets or formats, once they get past these current comps and inventory issues.
Makes sense. And the collaborations. We touched on the NSL deal. Abercrombie & Fitch is now an official NFL fashion partner. Also, Abercrombie Kids is launching globally with department stores like Nordstrom and Macy's through a licensing deal.
Both moves are about expanding reach, right? Getting more eyes on the brand, as they put it. Especially for Abercrombie Kids, which doesn't have many of its own stores. Licensing gets it into places like Nordstrom, reaches a different shopper. And the NFL thing, that could really broaden Abercrombie's appeal, potentially tap into a huge audience. It's an interesting play. And again, management kept referencing that battle-tested playbook, handling tariffs before, navigating the pandemic, inflation. They feel they have the tools to manage these current challenges too.
Okay, so pulling it all together, if you're an investor watching A&F, what are the absolute key things, the catalysts to keep an eye on going forward?
Well, number one is definitely the Q3 report and how they set up for the holidays. Specifically, are we seeing that Abercrombie sales decline narrow? That's critical. Second, any news on tariffs? Any policy shift could materially change that $90 million headwind for better or worse. Third, watch the share buybacks and any further updates to that full-year EPS guidance. It signals management's real-time confidence level. And finally, just the overall consumer backdrop. How strong is apparel demand going into the peak shopping seasons? That's always a big external factor.
Okay, that gives us a lot to watch. Now, this complex picture, the Hollister strength, Abercrombie's challenge, the tariff cloud, the conscious market reaction, it feels like fertile ground for some tactical thinking. So let's shift gears. It's time for our This Is Not Financial Advice segment. We're brainstorming some, let's say, outrageous but plausible trade ideas. Think like a hedge fund analyst for a moment.
And just to reiterate very clearly, these are speculative ideas. Do your own homework. Understand the risks involved. This is absolutely not financial advice.
Got it. So A&F, that market pullback post-earnings, the uncertainty around tariffs in Q3, where could the tactical opportunities lie?
Okay, trade idea one. The tariff tantrum fade, iron condor. Action. You'd sell an out-of-the-money call spread and an out-of-the-money put spread, both expiring after Q3 earnings are released. Rationale. The market seems pretty spooked by the $90 million tariff number in that lower Q3 EPS guide, but maybe too spooked. Management has their playbook. They're not planning big price hikes. Maybe the impact is, somewhat priced in already, or at least the fear is. This could lead to the stock just kind of trading in a range for a bit, not tanking, but not soaring either because of the lingering questions. And Iron Condor profits from exactly that low volatility. You collect premium if the stock stays between your sold strike prices. Plus, that soft Q3 guidance might actually set a low bar to beat, at least on sales.
Interesting. Playing the range, betting on priced in fear. Okay, what's idea number two?
Trade idea two. The Hollister hype Abercrombie hedge pair trade. Action. Go long a basket of other teen apparel retailers that are showing strong momentum, sort of like Hollister, companies really connecting with that youth demo. At the same time, you short A&F stock. Rationale. You've got this clear divergence within A&F itself. Hollister is, well, crushing it, 19% growth. Abercrombie's working through challenges, plus the whole company has the tariff issue. This trade bets that the market will eventually reward those pure-play teen retailers with strong momentum, while A&F might continue to be weighed down by the Abercrombie lag and the tariff costs. It's a relative value play. You're trying to capture the difference in performance between the hot part of the market, teen retail, and A&F's more mixed picture, isolating the strong from the struggling.
Right, betting on divergence. Again, folks, these are just ideas, speculative plays. They're sensitive to market shifts, company news, everything. Do your own deep dive, check your risk tolerance, talk to your advisor. Seriously, this is not financial advice. Okay, so let's wrap up our deep dive on A&F's Q2. A robust quarter overall, definitely. Hollister was exceptional, management seems confident, proactive on capital allocation, investing strategically, but that raised outlook comes with a big asterisk, the increased tariff impact. And that led to a cautious Q3 EPS guide and, well, a bit of a muted market reaction.
Yeah, so moving forward, investors really need to watch how effectively they manage those tariff costs. That's job one, probably. And we need to see proof points that Abercrombie is turning the corner. Signs of reacceleration there are key. Plus, assessing if those increased marketing dollars and the new store openings are actually paying off as we head into the all-important holiday season. Lots to track.
Absolutely. So for you listening, what are you watching most closely? How do you see A&F balancing these tariff headwinds and the need to drive brand momentum, especially Abercrombie's, heading into the holidays? Thanks for tuning into the deep dive. We'll catch you next time. Happy investing.